right, good morning, traders. This is your free daily video from seasonalswingtrader.com. I hope everyone is having a great week. Today we are trading lower in the overall markets. We want to take a look at one seasonal play lining up in Whirlpool. That's WHR Whirlpool, trading on the NYSE. And we had earnings last week that took the market lower. You see we gapped down here from around the 188.5 level all the way down to the 168 level. Today we're trading moderately lower, although the S&P is still down, continuing its weakness from yesterday, down about 11 points or 22.65. But today you can see that this seasonal bullish trend starts on January 30th, which was yesterday. We held off on the trade due to the overall weakness in the market. We were down about 20 points, the lowest levels we've seen all year. Granted, we're only 31 days into the year, about to kick off a new month tomorrow, February 1st. But it looks like this could be lining up nicely. You see the 5- and 10-year averages pointing higher. 8 out of the last 10 years, this trade has returned an average of almost 14.5% with a drawdown of less than 1%, 0.7% to be precise, with a cumulative gain of almost 55% over the last 10 years. And you can see down here on a week-by-week basis, the first week is actually the strongest part of the seasonal trend here, followed by strength in mid-March and again in late March, followed by a nice little rally here that is probably somewhat skewed due to earnings, but that closes out the trade here around April 25th, April 26th. So now that we've got earnings past us and we are looking for a possible leg up higher, if we go over to the real-time charts today, we're trading down about $1.40, almost 0.75% at 173.5. Here is the earnings outcome. Again, we gapped down from this level of 190 all the way down here to 172, traded lower on Friday down to 168. Now that earnings are shaking out, we did have a nice reversal off the 50% retracement level. That's pretty nice considering the fact that we were down considerably on the S&P yesterday. So we closed higher yesterday, trading a little bit lower today, consolidating some. But we are holding the 50% retracement. We're also holding the 100-day and held the 200-day. If we look over at the weekly chart, you can see here we are holding support at the 100-day average. Last week's action was pretty ugly, and that was due to earnings, so we'll move past that. Now, the short-term indicators, the 9 and 15, are turning lower. All the other indicators are turning lower, but if we do hold support here in light of the weakness of the broader market indices, we would look for a possible opportunity to get in. So let's take a look at the options chains going out to the March with around 45 days left till expiration. Looking at the 165s and 160s for strikes to short, depending on your overall risk tolerance. We've got the 165s trading at looks like $1, 97 cents. We'll call it $1, $100 per contract. Going further out, $5 down to the 160s will yield you about 65 cents a contract or $65 per option. So let's take a look at the 160s and the 165s back on the chart. Here's the 50% retracement at the 170 area. More aggressive traders could short the 165, 160s for the 65 cents. That takes us down to the 382. We've also got a good bit of support down here. Going down to the 160s will take you down to this support level right here. On the weekly chart, we've got the 165 resting here up on top of the cloud and also the 100-day. So we really want to see this 50% level hold as kind of our last line in the sand. If we start to roll down, break below the 50% retracement level, although if you short the 160s, you are $10 out of the money, we might want to look to maybe bail the trade because the 50% should hold. Our next target below that would be the 165 level, which would be the other strike price for the more aggressive traders. And that is what will be on our watch list for this week. Until next time.